Testing, testing. Okay, now we're good. All right. All right, guys. Good morning. Good morning. Don't worry if you're not here live. This will be recorded as always for you guys to check out. Welcome to the morning note. Happy New Year, everybody. Not really New Year, but December 31st, the last day of the new year. Ray, Happy New Year. Thank you guys so much for joining me. I was not on this past week. Obviously, I was on holiday in Washington, D.C. It was very, very cold, but it was nice to see our nation's capital again. It was my third time being there. Absolutely always a good time to go and see our national monuments, kind of see the capital of the country. It was really nice to go see. So, got some screen time away. It was good to kind of just, kind of reassess and get back into the new year fresh, clean, nice mental state where you're just relaxed. It feels pretty good. Always take some time away from the screens, guys, especially if you do this, only do this. Now, if you guys have a regular job, regular 9 to 5, and you're part of our service or you follow us, thank you so much for taking the time out of your day to do so. If you do this professionally or you do this only, I'm glad to be with you the whole way, kind of like your caddy, giving you the clubs so you can hit that fairway or making sure that you get out of that rough patch or the bunker if you guys are golfers. I like golf, but that's something in 2023 I want to get into a little more is golfing. But again, let's master the market first so I can earn some golf time. That's how my thinking is. So if we really have a good year this year, I'm probably going to treat myself to some golf clubs in 2023. So that's kind of my resolution for myself personally. In terms of the new year resolution, in terms of the market, whew, I think anyone can always put more effort. I think it's always important that we don't confuse effort with results. This year was not the best year. I think everyone can say that for everybody. It was very, very difficult for everybody, especially if you own stocks, if you own bonds, if you owned real estate from this year. If you were selling cars, if you're selling homes, if you're an investment banker, if you're in any kind of commission based business this year in sales, it was pretty tough second half of 2022. But again, if you're a salaried employee, if you work in the leisure industry, if you are someone that works in travel as well, or in high demand jobs, maybe medical field, something like that, or in the oil field, you probably did pretty well. So again, let's take a always think of yourself or everything in the totality, where one person's bad year or bad day can be someone's good year, good day. This was the year for the Bears. So if you guys were short stocks this year, you basically killed it. You had a great year. If you were shorting stocks in 2021, you probably didn't. In 2020, you probably didn't. But 2022, great year. So I want to go over the week first. Let's go over this past week, kind of go over everything. We'll go over some of the economic data that comes in next week, kind of prepare you for that. I want to do that as well. And then we're going to go ahead and recap the year, start talking about what happened over the year, what changed, what we're looking at moving forward, yada, yada. And of course, your questions. Ray, thank you so much. Yes, this week was crappy, but a great time to rest the eyes from the charts. Yes, guys, I always kind of equate trading or watching the markets like an air traffic controller. Now, air traffic controller has a lot more responsibility. You don't want planes to crash midair. But again, I'm watching 3 screens every day. I have my iPad, I have my phone. So I'm in between a lot of things. I've been doing this now since 2014. Obviously, the scale has changed. So I have been through the boom bust cycles, definitely, 2014 to now. So it's been a crazy 8 years, an incredible 8 years. And I hope to do it for another 8 years or so or longer because I do enjoy talking to you guys. I do enjoy speaking about this every day. In terms of 2023, one more resolution that I want to do. I definitely want to get started on a sports podcast. I really, really love sports. I've talked about it so many times. I might just pull the trigger. I'll let you guys know if I do one. It'll be on the weekend. It'll probably be focused on just sports in general. I love soccer. Obviously, World Cup was amazing. Best World Cup ever, even though I'm not a huge Argentina fan. But congratulations to Lionel Messi, the greatest of all time, to winning his World Cup. I mean, guys, that guy has been fighting for that World Cup forever. I remember it's every 4 years. So if that's not an example of resiliency, I don't know what is. But it's been, at least in sports wise, there's so much going on. And with a podcast, I would love to talk about sports. No, not Garstool, Juan. No, this will be just sports related. I know I like Barstool. Don't get me wrong. I love the pizza reviews, but I don't think I'm that entertaining. I think with sports, we can kind of just jam out, talk about different things, talk about takes, and just have some fun. That's really it. That's something that I would want to do moving forward in 2023. So more golf and a little more sports talk. Obviously, focus on the market and do better, obviously. But we'll see what we get. So let's go ahead and go over the week. Let's go ahead and get started. Let's see how we ended for the day. Dow Jones closed yesterday down 73 points. Nasdaq almost green for the day. S&P down about a quarter point. VIX up about 1%, 2167. Equal weight S&P up down 0.41%. IWM small caps down about 0.28. 10-year yields did go higher, 3.879. We'll go over that here in a second. High yield credit did well, was actually green. Remember, high yield credit, we talk about that a lot. Investment grade down 0.63%. So again, a little bit of spread between the high yield and investment grade bonds. Let's go ahead and take a look at crude oil, right around 80. We'll go over that chart, 2.69%. Gasoline prices starting to boost up again, $2.50 a gallon. Gold futures up 0.22%, 1830 an ounce. Silver down about 0.29%. Bitcoin futures, at least in the closing of futures, 16,520, and Ethereum 1189, up 0.63%. Whew, a lot to go by. Euro dollar 107.04. I just have the ask price 131.10 on dollar yen, and pound dollar 120.92. The dollar index continued to fall. We'll go over that here in a second. I don't have the exact level right now. I think when TOS closes the books on the day, Dixie doesn't come up, but we can chart it together. Okay, let's go over the week of the S&P 500. So remember, Monday we did not have market was open due to the Christmas holiday, and then we tanked right before the morning started. We got to around 9 a.m. to around 30, 38, 37, kind of chopped around for Tuesday, kind of chopped around overnight, one more leg down, and then you got to around 3806. 3800 seemed to be that kind of support. We're going to expand this a little bigger, but you could see I drew some trend lines based on the wick, and it held pretty well. And then you also have the wick from last Thursday. This was the 3920 level. I believe this was the peak that we got for the past 2-3 weeks after the CPI number, that big pop. And then this was Powell on Thursday, which continued us down. And now we're kind of stuck between this range of around 3920 to around 3800. And again, I did draw that trend line here. So right now with E-mini futures, we bounced from 38.30 on lows to 38.68. We're above that trend line right now, but just wicking it. Remember, we wicked it here as well back on Thursday. So again, it is important to see how we open on Tuesday, because your next level higher, if we continue to go higher, would be around 3,900. Again, you've been stuck between 3,900 and 3,800. You've been chopping around. Very difficult to find any kind of edge there because it's just been reversals on reversals. Remember, we talked about that on the newsletter. Noah's newsletter this week. I'm going to use this as our newsletter for the week. So again, if you do want to see this over and over again, YouTube is the way to go. Just click on it, listen to it at your leisure. But again, really just chopping around here, not much going on. Again, this is what we expect on the last 2 weeks of the year. Even next week is a short week. So again, I wouldn't put too much emphasis on these short-term moves at this point, because as we can see, we still have a downward trend. Let's go ahead and expand this now to a 1-year basis so we can see how the rest of the year did. So again, we'll start from January on the top, January of this year. How different do we feel today from December 31st of 2021, or 2022? And what a difference, 48.08 to now we're at 38.68. I thought we would get that Christmas rally, and I was not the only one who thought that, and we did not get there, unfortunately. We did get that rejection. Thank you to Powell, and again, his hawkish tone in terms of the Fed. But in terms of the market right now, remember, guys, 35.02 is still holding. That hasn't changed. So the bottom is in, at least for the year. Yeah. Congratulations, Carlos. You got the bottom in for the year. Who cares, right? Doesn't matter. What matters is that what happens moving forward. So again, kind of looking back on things is kind of rudimentary. Oh, what could have I done? What didn't I do? But again, let's just chart it, and then we'll go over some numbers on how the year went. But again, that's how the week went on the price action in terms of the S&P 500. And again, we know this trend line: 1, 2, 3, and then 4, right? And then we had this channel coming up higher. We broke below that channel. Now I have this here. A lot of lines on the screen, but I'll go ahead and explain it to you. So again, within the year, really was a bear market year. So here are the numbers for this year in terms of how the stock market performed. The S&P 500 was down 19.4%. year to date. That's the SPY. Not a bear market by the end of the year, but we did hit a bear market. So we're above a bear market. The NASDAQ, QQQ, down 33% this year. So again, pretty ugly. One of the ugly ones, the worst one since 2008, S&P, worst one since 2008. The Dow Jones was only down 8.8%, was not even in correction territory. And we're going to go over those stocks in the Dow in the Dow Jones Industrial Average. Again, that's value names. So again, let's kind of go over the S&P and how it went for the year. We fell here right into February. This was right into the invasion of Ukraine. And then we bounced and then we retested. And that level was right around 4,200. And then right then, I thought we did hit a bottom personally. I thought that we held that level here around 4,200. We took away from 4,800 to 4,200. That's a correction. That was kind of in the same ballpark of a rising rate environment, what we usually get 10 to 15%, 10% downdraft, maybe 8% or so. We did bounce back in April. Seasonality, spring tends to do very solid. And then we just pretty much fell from there, 46.33, all the way down, straight down into May. The saying goes, sell in May and go away, and you got to around 39.68. We did bounce back around 41.65 back in June. Nice little pop. Came back down for extra fall to around 36.40. Bounced again to that 200-day at 43.16, but again, still that trend line. Fell back again to 3,500 back in August. So we peaked right there in that August summer rally, bear market rally, and we came down pretty hard. But the good news is right at 3502, we had that CPI number. We had a nice bounce, and then CPI started coming down. And we stayed in this trend here. You could see this channel, up, 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 and then this is what we got with Fed Chair Powell right here. So again, the only thing that really has changed within last year and the year before is rates are higher. We have a very hawkish Fed. We have geopolitical issues and inflation. Well, we know now with CPI numbers and commodity numbers that inflation at least has peaked in June. That's what we know. We've talked about that now forever. So why is the market still need to come down? Why is it still coming down? Well, let me ask you this question. Right now, let's say you had $10,000 in your account, whatever, $10,000 cash. Would you want to buy stocks at this very level on the 31st of December? Probably not. Probably not buying any stocks the last 2 years, last 2 weeks. More than likely, what you're getting the last 2 weeks is positioning, maybe closing up positions if you were short, if you were long, or anything like that, kind of just closing up the books for the year for tax purposes or what have you. So again, where we are today is in just range. So let's go and take a look at this Fibonacci setup where we had from the bottom of 3502 to that wick top from the CPI at 4175. Here's where we are. We're above the 50% retracement level. We're above that. We're on the right side of the 50% retracement level to the upside. So again, we did hit that support. Great. That's terrific. Let's go ahead and take a look at NASDAQ and see if we can take a look at that. And then we can start looking. Oh, let me see if I can zoom in this here. Here we go. So we had the highs here. Here is your highs in terms of the CPI number. The CPI number highs, and then we had the what was this called? We had the Powell fall. So we just did the Fibonacci level. Let me see if I can edit the properties so it could be a little easier to look at. We'll go to yellow. No, that's not right. Let's go ahead and go to edit properties. Select color for everything. We're going to go to yellow. We're going to go to OK. All right, so now we have our Fibonacci levels for the short-term moves of QQQ since the low of October to the high of the CPI number in December. And where are we? We're at a 23.6 fib. We're nowhere near where we are on the S&P in terms of the 50% retracement. We're not there. We're on the bottom end. So again, NASDAQ at least has a little more to go. And again, if we start getting a little more worsening headlines in terms of liquidity, in terms of geopolitical, in terms of inflation data, in terms of employment data. Again, in a weird way, we're not in a recession in terms of employment. Employment is still very, very low, historically low. Wage increases are higher. I had a discussion with Nick DiGiacomo, one of our VPs at GAR Capital. I told him it's a rich people recession. It's a rich people recession, which is funny, and he laughed because most people that are working a regular job that have a salary, maybe a union employee or someone that has in the medical field, oil services field, stuff like that. Those individuals, really nothing has changed gas prices have gone down, inventory has creeped up, so prices have gone down for apparel and stuff like that. Now, traveling is a different story. We saw what happened with Southwest Airlines. That was more of a weather situation, but again, they don't have enough workers for those for the travel and leisure area or hotels and stuff like that. So again, if you work in the leisure hotels, more likely in 2020, you didn't do well, but in 2022, you're kind of making up for it with your job and your salary and what have you. Rich people recession, what does that mean? Anyone that's in commission based. Let's say you are a real estate agent. This was definitely a tougher year for you than in 2021 or 2020. How about a mortgage broker? 2021 and 2020 did pretty good. 2022, not so much, rising rates. How about a car dealer? If you were a car salesman, right? Rising rates, a glut of inventory, you have to bring down prices. That's less a commission for you. You're probably hurting. If you're an investment banker at a Goldman Sachs, some of them got laid off. There's no M&A. Who's going to do mergers and acquisitions in this environment? So what you had this past year was that in 2020 and 2021 was the party time. Everyone had fun. Everyone did their thing. Everyone was making money. And then 2022, the bill came. So let's make the analogy here. 2021 and 2020, we fed, or the market fed you cheap rates. They fed you sugar. They fed you junk food. They fed you chocolate, ice cream, soda, chips, hamburgers, fries, all the junk food, right? And I love me some junk food, but they kept feeding you and feeding you and feeding you and feeding you. So you got really comfy, really fat on that couch. You didn't do much. 2022, a gym trainer comes in, breaks down the door, says, you need to lose weight because if you don't lose weight, you're going to get very sick. You may get diabetes. I mean, create any scenario you want. Now, this big person who has only had junk food, a very an environment where he's just sitting down, relaxing, not doing much, not using any of his body or exercising. Now he has to go work out in 2022, and he's on the treadmill. Tough. That's kind of the analogy that we're getting is that 2020 and 2021 we got really really fat, and in 2022 now it's time to get in shape. How long does that take to get in shape, right? It takes a while. You don't go to the gym for one day, hit chest, and say, I'm built. No, no, no. Most times than not, what it takes about 6 months to see any kind of change with consistency. Obviously, diet and exercise. I think that's kind of where we are in terms of the market, in terms of like this was kind of paying the bill. We partied hard and then you finally got that check from the waiter and say, ooh, what did I spend? What did I do? This is going to be tough. That's kind of where we are. So it's kind of the analogy for you to understand in the macro environment what has changed. Interest rates have gone up, very, very difficult for others to finance or to buy things. Again, what we're trying to do is to wring out the speculation. That's what the Fed wants. They want to wring out that speculation. They don't want easy money policies to bring down inflation. Once inflation has come down, could they have changed their tune? Inflation has come down, and they have not. So that's kind of the issue that we have with the Fed. Do we trust them? Do we not trust them? That's the 2023 theme this year. The Fed, do you trust them or you don't? Historically speaking, they kind of changed their mind a lot. I mean, 2018 was pretty much similar to this. And in December 2018, I remember I'm in my office, just my hand in my head saying, oh my God, what happened? And in 2019, things flipped. And 2019 was a great year until 2020 happened, and then we had COVID, and then we went to the cycle. Do I think we will have a pandemic in 2024? Probably not. I think that cycle is basically done. But right now, the market is just paying the bill. That's what it seems like. We're just paying the bill. The market, the people are paying the bill for the party time we had in 2020, 2021. You had stimulus, you had low rates. People bought homes, people bought cars, people did different things. Now it's the time to kind of pay that bill. Does it last forever? Well, how long does it take for you to get someone into shape after them not doing anything for the past 2 years? It's going to take some time. Obviously, we need inflation to keep going down. We need consumption to go down. And I hate to say we probably need unemployment to go higher so wage pressures can go down. That's just the macro of it. And yeah, there's a lot more information that we need to go by because we had a heck of a year in terms of a crazy one. Big shout out to Bullish Rippers on Twitter. Big shout out to Stock Market News on Twitter. I am a paid fan of them on Twitter, and I get a lot of the info from them in terms of like numbers and prices and how the stock market performed. It's good to see. So big shout out to them. Let's go over the stock market, how the stock market performed in 2022. We'll go ahead and bring up the heat map together and see what worked and what didn't work. Let's see to 1 year performance. And here we are. Oops, that moved. Let's see. All right, guys, here we go. All right, so here is a 1-year performance chart of the S&P 500 stocks and where they what happened this year. So, more likely, if you own stocks, you own probably an ETF or something like that. You're more likely a owner of Apple, whether you like it or not, because you own an S&P 500 ETF. Apple down 27%, Microsoft down 29, Google down nearly 40, Meta down 65, Amazon down 50, Tesla down 65, Home Depot, not exactly a tech stock, down 23 points. T-Mobile up 20%. Activision Blizzard, thank you to Microsoft, right? 13.42% this year. Electronic Arts down 9%. What worked? Let's kind of look at that. So what didn't work? Growth. All this top left side, that's really all growth, guys. That's communication services, that's cyclicals, that's technology. All that growth stuff, they were down. I have SpyG stock was cut big time. Thank you, Tesla. Thank you, Amazon. Thank you, Google. Thank you, Apple. Microsoft. All those names were down. What worked this year? Value. When a rising rate environment, dividend paying stocks do better for the most part because they're returning shares, returning capital to shareholders. So Coca-Cola, again, you're talking about growth that's capped. 8% this year. Pepsi, 4% this year. Target, I had Target, bought the dip, closed out, made some money on it, 35% to the downside with the team. Dollar General up 4%. How about General Mills? Cereal up 25%. Philip Morris cigarettes up 7%. Altria up down 3%. So again, look at these names. May they not have been green this year, but they were not down 27%, 39% or so. Energy stocks. The one fumble I made, I bought energy stocks in the first half of 2021. Was XOP. I should have held for the rest of the year. It would have been a better trade. But yeah, we were in energy for a minute, and energy soared. XOM up 81%, CVX 52%, COP 68%. Energy stocks, oil stocks all went higher. So congratulations if you're an energy investor. How about we talk about weapons and aerospace? Well, when you have war overseas, that tends to help. How about Raytheon, 17%, Lockheed Martin, 37%, General Dynamics, 19.55%. L3 Harris was one of my top 10 stocks of about 2 years ago. That didn't do much, down 2%, but better than losing. Boeing down about 6%. Caterpillar, one of my top 10 stocks of 2022. I am not going to toot my own horn. That's pretty much one of two stocks that actually did well this year. But if you owned Cat, well done. Congratulations. Good year in comparison to what else is out there. UNH was not one of my top 10 stocks of 2022, but it is one of my favorite stocks that I own. It was up 5% this year. Disney down 44%. Again, all growth names went down. Well, take a look at the growth name that was actually green this year. Interesting. IBM. IBM was up this year 5%. IBM has had terrible luck it was been dead money for about 6 or 7 years. Remember IBM Blue, Watson, that wasn't making money. Their stock buybacks where the stock kept going down. Tough on IBM, but good for them to have a great year this year, or a decent one, relatively speaking. T-Mobile. T-Mobile doesn't pay a dividend. Interesting, right? They don't pay a dividend like a Verizon or AT&T. They don't have that debt the Verizon AT&T have, up 20% this year. T-Mobile, congratulations with them. Healthcare, J&J, again, as stable as it gets, up 2%. Boring, but that's where we are. Eli Lilly, 32%. Merck, 43%. Investment Club, well done, Merck. Well done. Didn't get it right a lot this year in a tough market, but Merck was a nice one. AbbVie, 1889. Pfizer, down 12%. Interesting. Pfizer was down in the land of healthcare. We continue further. Medical devices, Abbott Labs down 22%. So again, not everything other than energy was pretty much the only safe place to hide. If you were in energy, if you were in defensives, if you were in healthcare, if you were in aerospace, if you were insurance, you did okay. You're talking about Principal, AIG, Berkshire Hathaway up 3%. How much would Berkshire Hathaway done better if Apple done better? Remember, Berkshire Hathaway and Warren Buffett, they own a big position in Apple. I haven't seen that they sold anything. Banks, I've been saying that I wanted to own banks long term for a future bounce, and they took a hit. I own JPM, I own Goldman Sachs too, and they were down for the year. Goldman Sachs down about 11%, not terrible. JPM 15%. Visa down 4%, didn't do too bad. MasterCard down 3%. So people are spending. PayPal, oof, tough, down 62%. Just a tough one for all types of growth stocks. And why is that? Why were growth stocks taking a hit? When you are an aggressive growing company and you're just getting started in the market, or you're just getting started with your company, credit and the world is run on credit. This country is run on credit. It's very difficult to buy a house cash, to save for all these years to buy cash. Very, very difficult to do so, or to save cash to buy a car or whatever, washing machine. So you need credit, obviously, to get the stuff that you want now, which creates jobs and creates a sense of a quickness of when you get your products or your services. So again, when liquidity dries up and rates are going higher, it's tough for a PayPal, a Tesla, or these aggressive growth companies to get the needed liquidity to hire employees, to buy machinery, or to pay for marketing, whatever, all that stuff. So again, in a rising rate environment, growth goes down. Dividend companies that are stable, they have a pretty much a ceiling. Coca-Cola has a ceiling. They're not going to grow 10% in Coca-Cola sales in a year. That's just not going to happen unless they have some new formula that I don't know of, but it's the original formula, and they know what they're going to get. Maybe 1 to 2% increase in growth of sales, and that's with adding cost, increasing prices. That's what you get. Not fun, but it pays you a dividend, 2.1% or so. Sure. The issue is, again, with a growth stock environment, if you like NASDAQ, you like tech, and you're seeing towards the future, the first 2 years, 2020 and 2021, you did great. Hell, since 2009, you did okay. Really, the only years that were tough for tech, 2018 and 2022, since 2009. So again, we're in 2022, we'll call it 11 years. 2 out of 11 years were horrifically red for tech. But this is what you do. This is the risk you take for investing in these companies that still have more to grow. Again, if you're a Tesla shareholder that bought in 2020, 2019, let me make sure if I had that number correctly. If you bought Tesla in, let's say, March of the pandemic, you're still green. If you bought it in 2021, beginning of 2021, you're red. So how much does the people who've owned since 2020, how long do they hold out for Tesla? Because we're broke that, remember I talked about that 200-day. That was the bounce point for S&P 500. It sliced through for Tesla. Could we get more downside? I think that $100 a share seems to be that round number for Tesla where I think everyone's going to get interested in buying some. And how's this? You got one more gap to fill right at 82.39. So you do have a little more room to the downside unless the Fed pivots. Fine, if the Fed pivots, we'll take it if that's the case. And a pivot, guys, is from raising to cutting. There's a difference between pausing rate hikes and pivoting. What I expect in the Fed, let's go ahead and pivot to the Fed now. In regards to the Fed, let's go over first what happened. Let me see if I can get this. All right, here is the year to date. This was a letter sent by Bullish Rippers. They have a newsletter as well, just talking about all the news and everything. Love them, love them. I highly recommend you take a look at them. They're free. Market performance by sector. Energy beats everybody out the water. Communication services was basically nuked. So again, you had energy and consumers communication services. Remember, Facebook, or excuse me, Meta, Google, Disney. Those guys were absolutely obliterated this year. And if you bought energy, which was dead money for about 5 years, and you held on, congratulations, you did very well. Look at that, Oxy, up 117% this year. Hess, Marathon, you see it all. Let's go ahead and go over Jerome Powell and the Fed. March 16th, 25 basis points of this year in 2022. May 4th, 50 basis points. June 15th, 75. July, 75. September, 75. November, 75. That's a lot. So we got 4 rate hikes of 75 basis points. Then we had two 50s in May and December, and then the March is 25. Here's what I expect. We don't have a Fed meeting in January. We have one in February. So again, in January, we did not have one, and they knew that. We had one in December, which was 50 basis points. If they were still hawkish on where we are moving forward, or they think inflation is too strong moving forward, why didn't they just do one more 75, knowing that there's none in January? And then we would have gone into February seeing what we got. But they only did 50. knowing that there is no rate hikes in January. In my opinion, I think we get 25 in February, and then it's a pause. And then they see where they go from there. It doesn't mean they can't raise rates again. I think they're going to give the market, I don't think they'll give the market a reprieve. I think the market will see a reprieve with a pause. Do I think we're going to soar right after that? No, but enough for a couple of points, a couple of handles to the upside, maybe 20 or 30 S&P handles. If we go ahead and bring up the S&P 500 futures, and you could see here on the daily what I'm looking for. And again, I know there's a lot of lines on the screen. Just bear with me. I'm still looking at one key level, and it's right around 4,000. And why is that 4,000? Because it gets us back into this channel. Now that channel is broken, but again, if we can get back up there to around 4,000, especially with a pause, we could start staying in that trend line and maybe get a little higher. But 4,300 is a big nut to crack. I don't think we get to 4,300 in the first half of 2022. More than likely, we'll probably get that to the second half of 2022 if things work out okay. Even with the recession, mind you guys, most recessions last about 9 months. And we've had a GDP recession already. Don't let anyone tell you otherwise. We've had 2 consecutive quarters of GDP declining. That's a recession. We are in a recession, technically. I call it the rich people recession because if you have assets like stocks, like bonds, like homes, like real estate, you are feeling the recession. If you're a regular Joe, middle class, working Joe that's going to the office, doctor, lawyer, a salesman on the phone, or nurse, or someone who does customer service, you're pretty much not worrying about anything in terms of employment at this very juncture. You're getting your paycheck, and if you don't have a lot of stocks or you just have 401k, you're really not thinking about what's going on now. But for those who are very asset heavy, you're feeling it. You're feeling it. You're feeling that liquidity crunch. You're feeling that you're not getting the same income that you had back in 2021 and 2020. This is what the Fed wants to bring down. They want you to feel that heat so you can stop spending. And we talked about this in Q1 of 2022. I said inflation is like a hot dog stand. If you own a hot dog stand in Midtown Manhattan for $1 a hot dog and you got a line all the way to Central Park, you're going to raise prices. Why? Because you want to make more money. Duh. This is capitalism. So you raise it to $2. The line gets a little smaller, but it's still backed up to, let's say, Fifth Avenue, and you're in Midtown. Okay, let's go to $3. And you just keep going and until that line gets to the point of sustainability. Let's say you said the hot dogs are $5 each. No one's paying that. You're empty. So now you know what your price ceiling is. Now you bring it down to the $3, maybe $2 range. You still have a line. You don't have supply chain issues. You don't have demand issues. You just are creating a price that still gets people in line, still gets you the maximum profit and keeps you in business. Because with $1 hot dogs, your line is out the door. And you're not going to have enough hot dogs to sell out. This is what happened with a lot of assets, a lot of things. People wanted sneakers, people wanted clothes, people wanted watches, people wanted cars, people wanted homes because they had extra money from staying home during the pandemic. They didn't drive anywhere. They had stimulus money. They had all that. So again, less spending in 2020, and then 2021 they spent it. 2022 you're paying the bill. Credit card balances are higher, even though Bank of America is saying that the consumer is still strong. We'll see what that goes from there. We'll keep an eye on retail sales as we move forward. And then the consumer balance sheets, consumer credit, we're going to see all that as we go. But again, back to that hot dog analogy, hot dog stand analogy. Again, guys, everyone in their mind, you almost have to kind of be careful with that price adjusting with the demand adjusting. Again, Jordans, I'm pretty sure there's some Jordans out there, and I love sneakers. I'm not paying $1,000 for Jordans. I'm just not going to. Even if I had $1,000 stimmy, I'm not doing that. Now, if we're talking $200 retail or $150 retail on sneakers app, sure. But StockX, I'm not going to pay $1,000 for sneakers that are regular price 200. I don't need them that bad. In 2021 and 2020, some people did. They spent thousands of dollars on shoes because they had extra money from being home during the pandemic. And they didn't have to drive that much, or they worked from home and they didn't go out as much. Now everyone's traveling. So what you're getting, guys, is more of a shift from buying stuff to doing stuff. The problem is that I bought some airlines stocks and they continue to go down with that thesis. So people are traveling, but the airline stocks are not exactly complying, even with lower oil prices. Mind you, that's where we are. We'll take a look at the airlines earnings reports and see how they did. But in terms of that first quarter, and I said this about the Fed, I said it is easier to create more supply than it is to create demand. It is hard to put a gun to someone's head and say, I want you to buy my stuff. That doesn't work. You can send coupons. I get mail correspondence all day for different things, whether it's lawn care service at my house or roofing or like doing different things around the house, like handyman. They can't force me to want to buy it. But again, a really good price for, let's just say, cleaning the house or cleaning the roof or cleaning the shingles or whatever, that's going to probably get you into wanting to purchase or sign up for that service if the price is right, right? Price is right. But if the price is too high and you're at the point where, yeah, I really don't need so, these individuals, these businesses, now with the rising rate environment, demand is coming down, they're going to lower their prices. So nature is kind of healing that way. So the Fed said, okay, we can't control supply. We're going to kill demand. We're going to make sure that you don't buy anything. And we're going to make sure that you have a recession because a recession is the best way to end inflation. The good news is that we are rolling over inflation. The bad news is the Fed wants scorched earth, at least right now. Do we think they're going to really continue with that? We talked about that in 2018. They were all about that. In 2019, they flipped the script. So, again, if you take the Fed at face value, if you think the Fed is going to continue what they're doing all the way to September, then you're going to have a continuation to the downside. But if you're seeing it the way I see it, I think we're going to get a 25 basis point hike in February, and I think they pause. And if they pause, we'll get some reprieve. Could they get back on and do it again? It's a tough one to say because we still have the war in Ukraine as well, and China with COVID and everything like that. And like right now, we're starting to see people spending probably a little less on things. We'll take a look at that retail sales. The problem is this: how far gone can demand go before the Fed says mission accomplished? How much misery does someone need in order to get to that point where the Fed says, okay, we're good? That's basically where we're at. So again, if we're more resilient in this market or more resilient in this economy, the Fed is going to keep pressing. If we believe them, we'll see what we get. But that's what I see as of right now in the market. I will go over with Investment Club all that stuff of what I think moving forward. But again, I want to do this note for you guys to kind of give you some of the background of the year, what worked, what didn't work, and what to move forward. So let's go over now crude oil. And again, we've talked about this forever, 130 to around 80. It basically cut 50% in half. Oil. We don't talk about that enough and how much that is very delicate. And I'll tell you why. This country is run on two things: high home pricing. We like prices high. We like homes to be high priced because we don't want, in a weird way, Americans want to have their suburbs. They want to be away from the city. So we don't want housing to be affordable. We want housing to be attainable, but not too attainable. In a weird way, we kind of want, our own little islands of homes. And then we kind of see our homes as our piggy bank. So we want prices to keep going higher so we can borrow equity, or we can just say, yeah, I bought my home and now it's worth double. I mean, I think that's what we like. And the second pillar of American economy that we like is cheap oil. Cheap oil, cheap gas, that's been our thing. For a middle class individual, what is their parameter of an economy? What in their mind do you think is what they think an economy is doing fine? If you were driving around in your car today and you saw $1.99 in gas, more than likely you would think the economy is doing pretty good. You'd be like, wow, $2 in gas is cheap. Man, economy's doing pretty well. Not including housing prices are going up, not including the car prices are going up, whatever, whatever, whatever. But for some reason, that barometer of economic activity seems to be the regular cost of unleaded gas. It's been that way forever. I remember in the 90s where gas was 97 cents by my neighborhood in Miami, Florida. And this was during the Clinton years. I think it was around 98, and everyone was excited, like, oh, the economy is doing so great. And it's really just gas prices, of all things. That was like the one little thing that kind of got people to say, yeah, the economy's better. And that brings consumer confidence up. Consumer confidence was up because gas prices were down. It sounds so interesting and weird to just you and I who talk about this stuff every day. But gas prices are so important to individuals out there because they have to gas up to get to work. In weird ways, like I got to get to work, I got to put gas every week, every 2 weeks. If that price goes down, I feel a little more confident that I can buy some luxuries, or I can maybe go out to dinner with my spouse or my kids. So that's how they see it. How we see it, what we do every day, it's the Dow, it's the NASDAQ, it's the S&P. That's how we see it. And when you're seeing you're down about 19% on the S&P, yeah, you don't feel pretty good. But again, if you ask, try this exercise when you're out and about with friends, maybe that are some that are not in the stock market. Ask them, take this exercise, ask them, how do you feel about the economy today? They'll more than likely say, it's not the best, but it's doing a little better. And yet you and I are probably thinking to ourselves, doing better. Do you see the stock market? We broke the 200 weekly MA on Tesla. We're screwed. I can't believe it. But to the regular Joe on the street that doesn't understand this stuff or doesn't look at this stuff, they're probably saying, yeah, everything's fine. I'm planning a vacation. I'm doing this because they have their job, they have their paychecks. So, again, you have different perspectives. Remember, life is about two things, as always. Here's my advice I always give it to individuals and friends of mine. Life is about two things: expectation and perspective, always. One man's horrific event is another person's celebration. France, after the World Cup, oh my God, I can't believe we lost that match. And in Argentina, it is party until the next 5 years. But in France, they did win the World Cup, the last one before, but they don't want to talk about it. It was the worst World Cup in their mind. It was rigged, probably. Who knows? Whatever. We're not going to talk about rigged or not. I'm just saying in their mind. I think it was a clean game. I thought it was an excellent game. But for French fans, they're probably thinking that was the worst World Cup ever. For the Argentine fans, it was the greatest World Cup ever. Perspective, expectations. How about Morocco? Congratulations to Morocco to getting to fourth place in that World Cup. And you probably, if Argentina won fourth place in the World Cup, they would probably be pissed off in Argentina. But in Morocco, where the expectations are lower, they're celebrating in Morocco. And congratulations to Morocco for making fourth place in the World Cup. That's amazing. Again, expectations and perspective. Now let's go ahead and pivot that to the market. What is your expectation for this year? What are the banks saying this year? Oh, yeah, we're going to continue to fall. It's going to be rough. So the expectations are now really down. We're bringing those expectations down. We're screwed, guys. We're screwed. Whatever. If we're flat this year, I'll take it as a win. If Google doesn't fall another 40%, I'll consider that as a win. I think what we're trying to do now in a weird way as individual investors is that we just want to make sure that we're not surprised. That's all it is. We don't want to be surprised. We don't want to be just taken aback. This year was taken aback for a lot of people. So now you're going to see a lot of bearish forecasts. You're going to see a lot of people saying, oh, we're going to continue to go lower, and they may be right. But again, that's their perspective and that's expectation. So if I told you today, the S&P by next year in December 2023, we close at, let's go ahead and just do this. I told you we closed at 4,000. Would you consider that a win for the year? Not really. Would you be like, oh, well, it wasn't terrible if we ended up at 4,000? If we ended up 4,500, party time, right? If we ended at 3,500, oh, we held the lows. So again, it really depends on your expectation. What are your expectations for the new year? Do you think you're going to have another 2020, another 2021, another 2018, another 2022? Again, just depends on the person. So it's really important to understand that where the market dynamics are, where all the players, all the traders, all the investors, all the fund managers are thinking to themselves, is this going to be a lost year? Is 2023 going to be similar to 2022? Or is it going to be like 2018 where it's just a one-time thing? Remember, 2008, we had the crash towards the tail end of 2008. In 2009, we bottomed just a year later. What's the difference between now? Could it be a bottom? Could we not? Could we wick 3,300? Could we get to that level? Sure, we definitely could. Could we end up higher? Absolutely. It just depends. It really does. And I show you what depends. Let's go ahead and remove this drawing. Now I'm going to go ahead and remove these Fibonacci levels, and we're going to start from scratch. And we're going to start for the past 3 years, and we're going to kind of do this in a way of a timeline. Check this out. We're going to do here the Fibonacci levels top to bottom. We're going to do 4808, 25. I thought I had it. Talk about a morning note that's running long, but it's fun. Let me go ahead and get this over to 221.74. That's your COVID low. Let me see if I can activate this drawing. It's at 4808. Am I correct? Perfect. Okay. Here is your Fibonacci level for the past 3 years. And what a 3 years it's been. From the COVID low of 2020 at 2174 S&P to the high of 4808. If you guys remember very, very closely in October, that 200-day moving average was right at that 50% retracement. All we have done is we went from 2174 to 4108, 4808 in one of the biggest sword jobs that we've ever had in the stock market in decades. 2174 to 4808. We effectively more than doubled in the S&P. Now we are just checking back to that 50% retracement. Now there was some people that are saying 3,300, that'll get you to the 2019 high. That sounds about fair. I don't think that's wrong. I say the bottom is right here at 3,500. We would just get back 50% of that big pop, get us back to a level that we haven't seen since October 2020. That's pretty much what I'm thinking that we'll get. I think we can retest that absolutely to right around 3,500, but I think we kind of stay around there for the simple fact that from two extremes, remember 4808 to 2174, we add those two and we create an average. What would be the exact midpoint, the median, back to math class, the median point? 3941. If we are just in the average of those two, from the big peak to the bottom there, 3480, 3491 seems to be that fair value level between both, not the two extremes. Again, the high extreme, the low extreme. 3491 is that midpoint. Could we retest that? Absolutely. I still think we hold, and we did hold. We did hold right there. Now we pivot to this. How much bad news do you need to price in? Tell me what we have not priced in. War overseas. We have unemployment still okay. Unemployment could still tick up. We have these stock prices that are gone down completely. I mean, we saw that Apple alone, which is a bellwether, down to what, 26% for the year. We have interest rates still rising, obviously. And then we also have supply chains that are easing at least. But we pretty much priced in the kitchen sink. And I said this on Twitter. I said, as someone who watches this every day, there comes to a point, guys, where you start pricing in Armageddon. The world's ending. And that was October. And then what happens? It just bounces because what you're not going to go to zero on the S&P. And I remember having this discussion in 2020 when we had the investment seminar. Everyone was afraid. And I think that we're starting to get to that point of fear. I think once we break 3,500 and you start getting to around 3,300, that's probably the level where it's overdone, that it's over. I don't think we get to 3,000. I don't think we get to 2,795. And I definitely don't think we're going to get back to COVID lows. The one thing that does give me at least some reprieve in this market, even with this choppiness the past couple of months, past couple of weeks with Powell and everything, that support of around 3,500 is still holding up. We're really far away from it, about 368 points away. And one more thing I haven't talked about. I know it's a lot, guys. My apologies. What's the run time on this now? I don't even know how long I've been going. Let's go to the dollar. The dollar's been important. The dollar, in a sense, has been a barometer for hard money policies or inflationary policies where, we're trying to hoard cash, right? Because inflation. So let's take a look at this chart. This is the max chart. And again, you could see that trend line that we had. It broke above, came back down. Excellent. And then we have this trend line here. So again, I know there's a lot of lines on the board, but again, you could see finally start breaking down. I think we get to below 100 on the dollar this year. I really do. And why do I say that? Because interest rates are gonna come down. They are. The Fed will pause somehow, or the bond market will not believe them. It's one or the other. Now, bond yields have come back higher, yes. And we'll bring up the 2-year to give us a bit here. And remember, we had the inverse head and shoulders, and then we hit that support around 25.75. Inverse head and shoulders hit that support around 34.73. Still to continue to go higher. Now, the pain point is right around 4.3, and we're not there yet, but we have some gaps to fill to the downside. So we'll go back to the dollar, and you could see that trend line, 101.65. We're below the 200-day on the daily. We just need bonds to get bid so we can get there as well, but we're not there yet. So we do need bond yields to continue to go down. I don't see that happening at least anytime soon. Really until the Fed, but the dollar might give us a little bit of reprieve where if we do get to 102, guess what goes higher? Euro dollar. Yeah, 107.81. Look at that. And the euro dollar was working hand in hand with the S&P, but a euro dollar, if you trade Forex, and I've traded Forex since 2014, the euro is a risk on asset. If you're buying euros against the dollar, you're more than likely bullish on riskier assets. Now we're getting that push. Look at this trend line, very similar to that S&P trend line, but we're breaking out of it. So the dollar is kind of giving us a little bit of a possible hint of what may be moving forward. And I think that if we get there, in terms of the euro getting above 107, 108 or so, I think the S&P more than likely has found a little bit of reprieve. But again, we're getting that spread. Look at this spread now. You could see up, 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 and then the euro right here, right around 2022 is where we started having kind of that correlation with it. So let's go ahead and bring up the 1 year daily, and that'll give us a little more of a view. So here's the S&P 500 SPX kind of moving in tandem with the euro, right? And then we did get this big spread down back in June, and then the euro caught up, and then the S&P spiked above, and we had that spread came back down. So kind of very close. So here's the question: does the euro catch up to the S&P? Or does the S&P catch up to the euro? Because if the S&P catches up to the euro, we're at 4,200. And if the dollar keeps going down, you better bet your bottom dollar we're there. Because the stock market is priced in dollars. If the dollar is worth less, you could buy more stock, right? Yes. And if the dollar is stronger, you get less stock. Or even you get more stock for your money, right? With a stronger dollar, less dollar, we know the deal. So in a weird way, listen to this. The stock market boom that we had, was it really just the dollar being cheaper? And now we're paying the bill? Kind of working around towards that. If we get this coupled again, remember, look at this spread. I want you to look at this. Look at 38.39 on the SPX. And right here, look at that euro dollar. And again, we've had spreads. And remember, we had the S&P come back down. The euro came back to it. The euro was right here. The S&P spiked up. And then kind of that one-for-one correlation. But now we're getting this spread here. What catches up? The euro catches up to the S&P, comes down below 1, maybe. Or does the S&P catch up to that dollar move and get you to around 4,200? All possibilities, but the dollar key 2023. What do we need to look at? We need to look at the dollar. We need to look at yields. We need to look at the S&P. And the one more thing I want to look at is high yield credit, HYG. If HYG, and you could see how close that is with the S&P, right? If HYG, high yield credit, breaks out of 74.23 in that S&P 500, this is the high yield credit trend line, very similar to the S&P 500 trend line, very, very similar, kind of like that yellow slice down. If high yield credit, which is the riskiest credit, think of this as lending money to someone who has a 600 FICO. If you have money to lend out to those individuals, you're looking for a little more yield, higher yield bonds, right? If they continue to creep higher, if we can get high yield bonds continuing higher, maybe 77, we got a little space here, got a little bit. But again, we've had times where these spreads have come back down. So again, high yield credit, which is in the candles, we had the spread here back in August. We had a spread here back in November. Now we're kind of close to it. So if high yield credit can kind of come back a little bit higher, maybe get to 79, that remains to be seen. That's the 50% retracement on the daily. And then we'll see some risk assets continue to go higher. Woo! A lot of stuff I went over today. A lot of macro. I hope you guys enjoyed it. This morning note was probably the longest morning note I've ever had, but I appreciate you guys as always. It was so much to look at. And thank you again for taking the time out of your day to join me. I'm going to take the rest of New Year's Eve and just relax, probably watch some football and watch that college football championship, the semifinals. I'll watch that. If you enjoyed this video, please hit a thumbs up. Make sure to subscribe. Subscribe for 2023 to our YouTube channel. Would appreciate it as always. And I will see you guys on Tuesday for the next morning note. We got a big one coming. Did I go over the Forex calendar? Excuse me. I did not. Here is for January. January 2nd, we are closed. Market holiday. We got ISM PMI on Wednesday. We got OPEC meetings on Tuesday. We got ADP private payroll on Thursday, and Friday we got non-farm payrolls. Always fun, always fun. So again, I just want to take the time to say this. Forget the market right now. The time I want to say is thank you guys. Thank you guys for just following. Thank you guys for just pressing a like on our Instagram page. Thank you for just commenting your questions. Thank you for just being here, even if it's for 1 minute a day. It means the world to me that you're here. Sometimes I do think back personally, and I say, what the hell? Why do these guys care about what I say? But you guys do. And I love it because now I can talk to you like we're having a cup of coffee down the street. This is why I do it. I love talking and teaching, and just this is the stuff I like, man. Sports and stocks. Those are the two things I can go on and on about. So, again, guys, from the bottom of my heart, gratitude isn't even the strong enough word to say how much all of you mean to me. I want to give a big shout out to my amazing, amazing staff. Juan Gomez, who commented earlier, thank you for all you do. Kevin Garcia, Nick DiGiacomo, Nick Blagvo, Vinci, you see him on his lives. Anthony Acosta, Jonathan Brennis, our great marketing team, Laura, also who is with us as well. Just great, great energy, great vibes around. It's been a tough year in terms of the market. We understand that, but we've been here since 2014. Ain't nothing new. This is 2018 to me. I've been there. I've been there. Want to pull my hair out. But you know what? There is always another tomorrow, guys. If you guys remember in 2020, we had that COVID thing. Everyone thought the world had ended. World had ended. It didn't. There's always another tomorrow, guys. Always have this in the back of your mind moving forward. It's not about hope, but you also need some reason to get out of bed, too. You also need something to look forward to, right? Attitude of gratitude. That's what my thing is. And in 2023, my New Year's resolution is to be the best version of myself for you all, to make GAR Capital the place for you guys to learn and understand the markets. I am not a flashy individual. I'm not someone that's just want to be in your face, going on yachts and all that stuff. That's not what I am. That doesn't help you. What helps you is this talking to you guys, answer your questions. This is what matters to me. And I love doing it, and I hope to do it for years and years to come. Have a happy and safe New Year's, everybody. I hope everyone has a great time. Please don't drink and drive when you get home. Get an Uber, get a Lyft, something like that. I've had friends of mine who've had DUIs. It's ruined their lives. It's been very expensive. So call it a public service announcement, guys. Just be careful out there. Enjoy yourselves. 2023, in my opinion, will be a way better year than 2022 in all aspects of life. Forget just the stock market. Now we have lessons learned. Everything you've done this year, guys, has been part of your journey, has been part of your lessons learned. Without adversity, victory does not taste as sweet, guys. Remember that. Remember the two things I talked about: perspective. Perspective, very, very key, and expectations. What are your expectations for 2023? What are your perspectives for 2023? Always keep that in the back of your mind. Thank you again, guys. The best is yet to come. I always say thank you, Juan. And I appreciate you guys as always. I will see you next year. Happy 2023. Cheers, all.